G'day and welcome back. In this video we're going to go through the very complicated area of income tax, and this area should be covered off very early in the piece, well before you really go through the process of selling the farm. In fact, it should be done at least a couple of years out. It gives you time to plan and to deal with FMDs and other big income events and smooth out the income potentially over a couple of years. Of course, here is our general advice disclaimer, and that's the type of advice we're providing now. It is general only, not specific and personal to your needs that take into account your situation. So, income tax in the last financial year obviously can be huge. Obviously, you get all the income in that 1 year, and obviously you've got no expenses for the coming year, which you normally do. And then you may have a clearing sale. And if all these things happens at the one time, it all goes into one financial year, and obviously that's where it can be huge. So when we have a clearing sale and we go to sell a tractor that's been in the family for 20 years, it's been depreciated down to zero. If it sells for 30 grand, then that is an income that needs to go on top of your other income for that financial year. So your depreciation schedule will show you that, and this is where your accountant really needs to get involved to get a clear understanding of that. Some farmers choose to sell off individual pieces of machinery, some of the bigger stuff, over multiple years to try to maximise the value of the transaction. So getting this right is really important. Again, you only get one chance at selling the farm, and making sure that the income tax side of it and capital gains tax, which we'll cover off in the next video, is well thought through and planned out a couple of years prior. Now, it's worth touching on farm management deposits, a fantastic tool to smooth out obviously very lumpy farming incomes, and that's what it's there for. Reasonable years for 2 or 3 years, and then drought the next. But with FMDs, they essentially kick the can down the road. So whilst it reduces your taxable income for that year, when they come out of FMDs, they'll be taxed as income into that year. So when you're heading into retirement, you really don't want lots of FMDs coming out in one hit. And once you're no longer farming, FMDs must be redeemed within 90 days. And then that's added to your taxable income. So what are your options? For people that have got substantial FMDs, some people retain or lease some land and continue to keep their primary producer status, so they can leave the money in FMDs and bring it out progressively in lower years. So most of the farm may have been sold off, leased or whatever, but you retain a mob of sheep, do a bit of farming, and you're still a primary producer. And then with lower income years, that's when the money from FMDs can come back in. So you're really about spreading your income out, and this is whether you've got FMDs or not, but spreading your income out over 2 or 3 financial years, where FMDs will come in earlier, and then you may have the farm sale, and then the machinery sale doesn't happen until July after the farm sale itself, after stock is sold and the like. So the timing of these things from a income point of view, grain sales, deferring grain, is really important. I think your accountant is ideally placed to provide your tax planning advice around this, and I'd recommend, as I've mentioned, 2-3 years out is an ideal time to start thinking about that. Our next video is capital gains tax. Now, this is where you'll really need your accountant. It gets really complex with the small business CGT concessions. So we'll see you there in a sec. Thank you for listening.